Welcome to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, we're talking all about cash savings options and money market mutual funds. We've talked a little bit about cash options and cash products on the show over the last few months, but we haven't dug into money market mutual funds in quite some time, if at all. Reason that I wanted to cover it this week is the SEC just voted to make some changes to the regulatory landscape that money market mutual funds must abide by. Money funds have been around for a long time, but there have been several structural changes over the last 15 or 20 years since the mortgage crisis back in 2008 and 2009. And I thought since the regulatory landscape seems to be changing again for these things, it may be a good opportunity for us to review exactly what they are, whether or not they might be a good fit for you, and exactly what you need to know about the upcoming changes. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Today on the show, we're going to be talking a little bit more about cash. Cash is a really relevant topic these days. It is probably more like front of mind, it's higher up on the importance scale with regard to all things finances than it was maybe a few years ago. Cash is always important. It's important in businesses for liquidity purposes and all sorts of other reasons. It's important to you and me and our household finances. But your choices for what to do with cash didn't used to matter a whole lot 3, 4, 5 years ago when interest rates were super low. Now interest rates are a lot higher. There are a lot more options. And the differences and nuances between what you do with your extra cash are far more impactful today than they were a few years ago. So we've talked recently on the show about how and when to take cash out of your business. Look back maybe 10 or 12 episodes. If you missed that one, we talked about how to get the most out of your FDIC insurance. That was a few episodes prior to that, I want to say. So you might look back a couple months, which is 12, 15 episodes, something like that in the queue if either of those topics are interesting to you. I wanted to talk more about cash today because the SEC is undergoing some changes and updates in the regulatory structure for money market mutual funds. And so to set the landscape for all this, if you've got extra cash that's sitting in the bank, you want it to be available to you and earn some interest in the meantime, you have a few options. You can put it in a high yield savings account, a bank account that's ready for you to draw off of at any point in time. You can put it in a CD where you're agreeing to lock up that cash for a certain period of time. It's still FDIC insured by the sponsoring bank. You can put it in short-term bonds. That's an option. A CD is a lot like a short-term bond. A money market mutual fund is another option here. And it's called a money market mutual fund because it's a mutual fund like any other. You give cash to the manager of this fund. They give you shares in return. But it's unlike other mutual funds because the portfolio of stuff in that mutual fund is only short-term debt securities or money market instruments, excuse me. So this historically has been a vehicle that it's not risk-free. It's not covered by the FDIC. So if the holdings in this portfolio are worthless the following day, which is one of the least likely things that's possible in the financial markets, but it's not covered by the government. Whereas your bank balances, you give money to a bank, they're supposed to hold it for you. And if they go out of business because they're acting foolishly or because they have a run on their bank or a combination of the two, then the FDIC comes in and makes you whole up to the first $250,000 subject to limitation. So a money market fund is a little bit different. It's not FDIC insured. It's used by a lot. This type of instrument is used by a lot of institutions around the financial world. If you want to take advantage of one, then you deposit money in an ordinary brokerage account and you purchase shares of this mutual fund. And when you want to use the cash, you sell the shares of the fund, you get cash back, which then you can withdraw from the brokerage account or wire out or whatever you want to do. So it is not, it takes a slight bit of extra effort compared to cash that you deposit in bank accounts, but the appeal is pretty clear. I saw something the other day, I think it was in the Wall Street Journal, that listed the national average interest rate being paid in savings accounts. It's by big banks, little banks, credit unions, everything in between. The average savings account interest rate right now is 0.42%. The short-term market interest rate is a lot higher than that. It's closer to 5%. And so if you get a high yield bank account somewhere, you can easily get close to 4% per year. You can probably do better than that if you find them. We're seeing 4.75% these days in high yield bank accounts. And so this is why this cash discussion is relevant today. Interest rates are going up. Some institutions and some cash vehicles are more willing to pass on that higher interest rate to depositors and shareholders than others. And so the question of what you do with your cash depends on, well, when do you need it? Are you comfortable taking any risk with it? Are you comfortable locking it up in a mutual fund that you might not be able to redeem for at least a day or two? What are all these variables? Because money market mutual funds are paying closer to 4.75% per year right now. Again, slightly less liquid than a bank account. It's not covered by the FDIC. But what's in the portfolio are not exotic securities. They're very short-term debt obligations issued by the U.S. government. And in some funds, they're also issued by highly rated corporations. So if you buy a fund that only invests in short-term government paper, government debt, it's basically the same thing as having FDIC insurance because the U.S. government is backing either of the instruments. It's not quite the case if you have a money market fund that also invests in short-term debt of highly rated corporations like Apple and Chevron and biggest corporations in the world. Think of any in the S&P 500. So that's the landscape, and that's why we care about this. Money market mutual funds is what we're going to dig into in today's episode. And they have undergone a couple of different rounds of changes in the last 15 or 20 years. And this really stems from the mortgage crisis back in 2008, 2009, 2010. The way these money funds work is that they have a consistent net asset value. So not only are they required to hold only very short-term debt obligations of, again, the government, and some will include highly rated corporations. But on top of that, when you own the shares, the net asset value, each share is supposed to be worth $1. And there's no formal, prior to 2008, there wasn't a formal mechanism that enforced that. It was possible for the value to fall below $1. But if all you're investing in are U.S. debt obligations that mature in one day or within a week or something like that, those things there's hardly ever a circumstance where the value is going to fall below $1. You give $100 to the mutual fund manager, you get 100 shares in return. If you hold on to it, the mutual fund manager is going to put your money together into the portfolio with everybody else's. They're going to buy a bunch of these debt securities, and the debt securities are constantly going to be maturing and reinvested again and again and again. And then periodically, so the value maintains the $1 per share mark, and over time, the mutual fund manager will distribute earning or interest from those debt obligations back to the shareholders. So the value stays steady at a dollar, and the interest that's accumulated from these debt obligations is passed back in a distribution to the shareholders. So that's historically how it's worked. Now, I said a minute ago that they can also invest in short-term corporate paper. And prior to 2008, there was really no delineation between funds that did and funds that didn't. You had to do your own research and dig into what was in the fund to understand whether they were investing only in government obligations or whether they were investing in other things like short-term paper. Some of them had mortgages. There was Charles Schwab years ago had this product called, I think they called it Yield Plus. And when I used to work there, it was like, using those words were kind of like Voldemort, because they wound up in putting money in mortgage-backed securities that lost a lot of value, and Yield Plus wound up resulting in a lot of lawsuits because investors lost some money. Because back prior to 2008, there weren't a whole lot of regulations surrounding what the mutual fund managers could and could not put in the portfolio. And so, like anything, if you take a little bit more risk and invest in more exotic stuff, it will earn you more yield. And that works pretty well until the world blows up and then you start losing principal. And so before 2008, there hadn't been an event where money market funds lost money or where the value fell to be worth less than $1 per share. And what we figured out during that crisis is that a lot of these money market funds were in fact putting some of the portfolio in mortgage-backed securities, other collateralized debt obligations, and less credit-worthy stuff. And the breaking point here was there was I'm pretty sure they were the biggest money market fund at the time, called the Reserve Primary Fund, broke the buck. And that means that their net asset value, so the value of the stuff in the portfolio, it had never happened before in the industry. It was all of a sudden worth less than $1. So all the investors in this fund, and again, it was the biggest money market mutual fund at the time, all the investors who thought they were putting their money in a safe cash product, all of a sudden now they're losing value. And the Reserve Primary Fund had a hard time meeting redemptions. And I think that they even, if memory serves, suspended redemptions. People were freaking out. They wanted their money back. Reserve Primary Fund said, sorry, we can't meet that request at this time. And that had never happened before. So it was a big deal. Okay. So fast forward a little bit. Sorry for the history lesson. And if this is boring to everybody out there, if it's boring to you, you've probably tuned out by now. I find this stuff fascinating because it helps us understand the regulatory landscape and how the structure of these things might change and improve in the future. And, since we've learned this lesson in the past from the money market funds, as other similar products and stuff evolves that's similar but new and different, we've learned all these lessons in the past. We just have to study history a little bit to understand the dynamics. So back to 2008, the Reserve Primary broke the buck. It fell to below $1 per share temporarily. It rebounded back to $1 per share and finally met everybody's debt obligations. Not meeting their debt obligations, met the redemption requests. So the people who wanted to sell their shares, they entertained that, sold the shares, gave everybody their cash back. So in the aftermath of all this, now fast forward, that was in 2008, 2009 happened. We're still in the middle of the crisis. 2010 is when things start to normalize a little bit, and the SEC starts to look back at what happened and make changes so that it doesn't happen again. And so I think that this was probably Dodd-Frank, I want to say, the piece of legislation. I should probably know the year, but I don't. When they adjusted what banks can and can't be participating in with their bank balances. It used to be that there was this big wall between taking bank deposits and then taking risk with them, investing them versus just lending them out commercially. And they reinstated that wall, basically, as a result of the crisis. And as part of that, they, you recall the stress testing that banks had to undergo. And so as part of the new regulatory landscape, so that we didn't fall into another mortgage crisis in the future, they changed all the requirements for getting a mortgage, all the reporting requirements, the documentation, the income verification, all that stuff changed for the better, because it was a huge hole that caused the crisis in the first place. But on top of that, the banks had to undergo these stress tests where if rates go up or down by X percent, or if your deposits go up or down by X percent, what is the impact on the portfolio and what is the impact on your financial stability going to be? And they had to work with banking regulators to meet certain thresholds to promote their own stability. So as part of that, that's when the money market fund adjustments and updates came into play. And so money market funds had to undergo stress tests as well. And on top of that, I think that they were limited in terms of how much exotic stuff they could include in the portfolio for the first time. So it was kind of the Wild West before 2010 in terms of the latitude that money market fund managers had. 2010 was the beginning of the changes that limited what they could put in the portfolio. And again, I think I'm pretty sure they were prohibited from putting just a whole bunch of equities in there and calling it a money market fund. I think that's blatantly wrong. But I think that they did have a fair amount of latitude. Now, fast forward to 2014. In 2014, they made some more adjustments. And I don't know why they didn't do this initially. I think that there were a lot of problems that caused the mortgage crisis that regulators, the SEC and FINRA and other regulators were trying to fix at first. And so they took a broad brushstroke at first and did a whole bunch of stuff and then came back and fine-tuned a couple of years later, would be my guess, is why they didn't do this initially. But in 2014, they came back and adjusted the landscape quite a bit. And so remember, I mentioned at the beginning, some money market funds invest only in U.S. government debt. Others invest in corporate debt as well. In 2014, money market funds were forced to classify themselves as either government funds or quote unquote prime funds. If your money market mutual fund only invests in U.S. government debt, you can call yourself a government fund. And in a government fund, the net asset value is fixed at $1 per share. Again, it's U.S. government debt, so it's not going to be, unpaid or anything like that. And if you're an owner of a government money market fund share or lots of shares, which is usually the case, then NAV stays at $1 per share, and you get income from the interest that the portfolio accrues. Operators of government funds are also required to entertain redemption requests at any time. Mandated. They cannot prevent them. On the other hand, if your money market fund is a prime fund, meaning that it also might invest in corporate paper, then you have more flexibility. The net asset value actually floats and can change from $1 to $1 and a penny to 99 cents. And on top of that, in times of extreme financial stress, prime funds are allowed to suspend redemption requests for up to 45 days. And so for the industry, this meant that if you're a money market fund operator manager, you have to make the decision of which boat are you going to fall into. And realistically, most managers out there have one fund that's a government fund, one fund that's a prime fund, one or more funds that are prime funds, and just offer different options. But the regulatory landscape changed quite a bit, and honestly, that move was very good for consumers because it gives you more confidence over what's in the portfolio. And if you don't want to take that risk at all, just invest in a government fund. By investing in short-term corporate debt, again, there is the risk that the corporation goes bankrupt and doesn't pay the portfolio back before you want to sell your shares. before that debt security matures, I should say. And so there's a little bit of credit risk in a prime fund. If you're comfortable with that, then you can get a slightly better interest rate by investing in a prime fund. If you don't want to take that risk because you want access to your cash at all times, you don't want any situation where you're prevented from selling your shares for up to 45 days, then prime funds are not for you. Government funds are a better fit. So now let's fast forward again to 2020, to COVID, when COVID set in. There's not been a whole lot written about this, at least that I've come across over the last couple of years. But when COVID hit, and there was those 3 weeks of really choppy markets, stock markets fell dramatically. Nobody knew what the world was going to look like at that point. And before rebounding steadily, the markets were really freaked out and equity values just plummeted. That was a time of a lot of stress in the debt markets as well. And issuers of debt securities had a really hard time. Credit froze up, meaning that, for example, U.S. government who wants to issue bonds to finance operations, credit was not available. Investors were not interested, not nearly as interested in purchasing those short-term debt obligations because they wanted cash. COVID was setting in. Nobody knew what was going to happen. And so at that time, there were a lot of redemption requests in money market funds as well. And because of the market dynamics here, and I wish I could articulate this in more detail, but it's just a little bit removed from my day-to-day on an ordinary basis. Because of that, the government had to come in and support the debt markets and support money market funds' ability to satisfy those redemption requests. Because even money market funds, or excuse me, even the government funds that are required to satisfy redemption requests in all circumstances, no matter what, they were having a hard time doing so because of the status of the short-term debt markets because of COVID. And so now we're coming the aftermath of this. This is how the regulatory cycle always works, right? The markets kind of evolve and people find these sectors and corners of the markets to make money in and exploit, and then things get arbitraged away pretty quickly. And then something will happen to, as the economy heats up too quickly, something will happen to intervene and either pop a bubble or put a damper on economic growth, and then those cracks in the system show up, and then we fill those cracks with regulation, a couple of years after the fact, once we realize what was going on and what structural changes need to take place. That's just the cycle. That's just how it works. So now the SEC is looking to make more improvements to the money market fund landscape in order to prevent that from happening again. And so there was talk, there were a couple proposals. Well, how are we going to do this? We don't want to be in the business of bailing out money market funds on a consistent basis. We need to impose a regulatory regime where these things are safe cash-like vehicles that people can invest in and have confidence they're going to be able to get their money out of. And so there were a couple proposals. One of the proposals is called swing pricing, and this is used a lot in Europe, as I understand it. I don't know a whole lot about money market funds in Europe, but I do know they use swing pricing. And what that means is that under times of duress, if there's a whole bunch of people who want to sell and redeem their money market funds all at once, the NAV of the fund is going to swing to reflect that. And that's a little bit different than you think, well, doesn't that make sense? If everybody's selling all at once, shouldn't that drive down the price? Well, yes, on a security that trades over the market, in the second-hand markets, over the counter. But with money market funds, remember, you're dealing with the manager, and the value of the portfolio is what it is. They just tally up the value of all those short-term debt holdings at the end of the day. It doesn't depend on how many people are buying or selling the mutual fund. It depends on what the underlying holdings are worth. And so swing pricing is basically, it basically imposes a tax on people who are all trying to redeem their shares at once. Because what you don't want to be is the person who isn't paying attention and gets left behind and hangs on to their securities, and then they wake up the next day and it's worth substantially less than what they thought because everybody else forced the manager to sell the holdings. That's not a good situation for really the whole industry or consumers. So swing pricing was one of the main proposals. It got voted down, and after it was proposed, the SEC takes comments from the industry and all this, and it was really, really, there was a whole bunch of pushback from the industry and lobbyists. The Investment Company Institute came on record saying they were very against it. Their argument was that implementing swing pricing and adjusting the value of what of what investors would get after redeeming shares in times of stress. So when everybody's trying to get out the door at the same time, figuring out how much to haircut the NAV is just a nightmare logistically. And that's kind of a valid argument. I think you probably could do it in a relatively simplistic way, but it clearly hurts managers of money market mutual funds when that's the case, because it's kind of a deterrent to getting in the first place. And they don't like that. They want to grow the value of the portfolio so that they manage more money and collect more fees. So the alternative that won out is applicable only to some money market funds and largely those that are not going to be held by you or me as individuals. Some institutional money funds, which are, if you add up all the money across money market funds in the industry, the vast majority of it are held by institutions. And so some of these funds that are held only by institutions will have a fee imposed on them when more than 5% of the portfolio wants to leave, 5% of investors in the portfolio submit a redemption request, but not by more than that. And that's different than swing pricing, right? If in swing pricing, yes, you have some threshold at which that might apply, but the more redemption requests you get, the greater the haircut, the greater the penalty. Here, we're just talking about a penalty being imposed anytime redemption requests are greater than 5%. And again, it only applies to funds that are held by institutions. And even then, not all institutional funds are going to be subject to this haircut. So what that means for you and me is that, things aren't going to change so much when it comes to our redemption requests. But what is changing is that, and this part has been probably a little underreported and is honestly more relevant to you and me, is the requirements for what money market fund managers are allowed to put in there. And let me look this up because I did take notes on this. So before this update, and this is a relatively close vote, the SEC has 5 commissioners. 3 of them voted for this, 2 of them voted against this. The 2 against it were both Republicans. It doesn't always go along party lines, but as I understand it, that's pretty common. But what money market fund managers are allowed to put in the portfolio changed a little bit. Before this change, they were forced to have at least 10% of the portfolio in holdings that matured in one day. So remember, these are short-term debt obligations like repurchase agreements or repo. You give me money for one day, I'll give it back to you plus a little bit of interest tomorrow. That's all it is. And so one of these changes is that they have to increase the portion of the portfolio that matures in one day from 10% to at least 25%. And that's a substantial amount. That's a substantial improvement in liquidity. And on top of that, they used to have at least 30% in assets that mature in 1 week. Now that ratio has to be at least 50%. So more of the portfolio, a substantially larger amount of the portfolio must be put in debt securities that mature in 1 day and 1 week. And if you think of the alternatives, when it used to be 10% and 30%, that means that 70% of the portfolio could be held in securities that mature in longer than 1 week. And for money market managers who are trying to, attract inflows, attract investors because they produce more interest than their competition, there's often a very large incentive to extend the maturity, the duration of your money market portfolio to get a little bit more interest. And the risk is that something goes haywire in the debt markets between now and when that note matures. In the case of COVID, that happened, and the Feds had to step in to shore up the system. So in a nutshell, that's what's going on. And what that means for you and me is that money market funds are now a little bit safer than they were before. I like that. And if you're in the position of trying to figure out what to do with your cash, your options are basically the same, but this landscape is evolving. And the differences between sticking your cash in the local credit union savings account that's paying you 0.5% per year and finding a high yield bank account, or putting the funds in a money market fund, or buying a CD, that difference is much, much greater. So let's put this in perspective. Let's say that you've got $100,000 as your emergency fund, or maybe $100,000 sitting in a checking or savings account in your business. If you're earning 0.5% on that money by just leaving it where it is in the local credit union, you're earning $500 a year in interest. Right now, the market rate on, again, money market funds and high yield savings accounts is closer to 4.5%. So that's 4% better than what you're getting right now. And just by being thoughtful about this, not taking any risk, moving it into either another FDIC insured vehicle or a government money fund that's investing in just short-term government debt and is required to satisfy your redemption requests at any point, and it's required to maintain an NAV of $1 per share, which means, it's not totally risk-free, but it's just as close to cash as you can possibly get. You're getting 4% more than leaving it in the local credit union. And on $100,000, that's $4,000 a year. That's a lot of dough. That's what? I don't know. It's the end of the day and my brain is fried and I can't divide that by 12 in my head. But it's a little bit less than $500 a month. I call it $350 a month, something like that. That's a lot of money just by being thoughtful over your banking balances. So that's why I wanted to cover this today. The regulatory landscape on mutual funds, and particularly with money funds, is relevant to investors. I don't think that most people need to know and understand all these details and minutiae. But as always, the markets and the regulatory landscape evolve over time, and it's important to stay on top of that to make sure your decisions are still in your best interest. So I hope this was interesting. I think that covers it for today, and I'll talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Be sure to subscribe to the podcast on iTunes, Google, Spotify, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements, and feel free to submit questions to growmoneybusiness.com.